Small Finance Bank has been one of our favorites, and we have seldom missed the opportunity to recommend it at an attractive price point, as we did at the onset of COVID third wave at a price of 1,043 per share. Since then, with the return of close to 23% as against 3% for Nifty and 6% for Bank Nifty, the stock has outperformed by a huge margin. However, with a unique combination of aggression leading to high growth, secured assets and a very adept management of asset quality issues amid challenges, a great build-up of a high-quality deposit, and adequate capital and robust technology, AU Small Finance Bank will certainly come out a winner. We see strong earnings trajectory going forward, and seen in this context, we see upside in the valuation. Growth certainly has made a meaningful comeback in Q3 as the economy opened up, since AU mostly lends to livelihood-linked activities. As against the pandemic times when growth had nosedived to single digits, in Q3 FY22, YOY growth in assets under management was more than 26%. In fact, disbursement figures grew handsomely by 59% sequentially during Q3. AU has a largely retail-dominated, secured and diversified loan book that is de-risked, while ideally placed to take advantage of the economic upturn. The bank has created 10 business groups that will operate as separate strategic business units, SBUs, to bring sharper focus in executing the bank's growth strategy with greater agility. Even in the worst of times, AU's gross NPA had touched a peak of 4.1%. The last reported quarter that saw a near return to normalcy saw marked improvement in its asset quality, with granular, largely secured loans used mainly for income generation and backed by productive assets, strong on-ground connect, and in-house sourcing and collection of loans. AU has done much better than peers in terms of asset quality. Slippage was flat sequentially, and there was a sequential decline in gross and net NPA. Collection efficiency touched a high of 106% in Q3. While it has a restructured book of 3.1% of advances, the same is largely secured, carries some provision, and slippage from it has been negligible. Finally, with the provision cover of 51% and buffer provision to the tune of 300 crores, we expect asset quality to improve going forward, and therefore, incremental provisioning requirement would reduce drastically as the economy opens up and macros improve. AU SFB has been slowly and steadily building a high-quality deposit book. The book is now dominated by stable retail deposits. CASA plus retail term deposits stand at 70%. In the quarter gone by, while overall deposits grew 56% YOY, low-cost CASA grew by 145%. Consequently, the share of CASA rose to 40% of deposits from 23% in the year-ago period. In fact, the bulk of incremental addition to deposits came from savings account. The share of deposits in total borrowing stood at 90% in the last reported quarter, and the entire asset book is now funded by deposits, which is a key factor in driving interest margin despite the bank lending predominantly to secured assets. Thanks to the improved composition of deposits, AU has seen a steady decline in its cost of funds and a concomitant improvement in interest margin despite a fall in yield on advances. We perceive the strength of liability as a key to capturing market share and maintaining a high-quality book. The bank has a very comfortable capital position with capital adequacy ratio of 19.5%, and it's leaving no stone unturned in terms of investing in technology as well as people to capture market share at a time when a large part of the bottom of the pyramid lenders have been rendered weak. We see a spectacular journey ahead for AU as it transforms into a universal bank backed by cutting-edge technology. While the cost-to-income ratio looks elevated, the investment for the future will differentiate the men from the boys. Although the valuation looks optically expensive after the recent run-up, it's worth noting that at a time of AU's IPO in 2017, it was valued at 4.5x one-year forward book, and it got listed at 6.6x one-year forward book. So we are getting a high-quality franchise at a steep discount to its listing valuation for a solid earnings growth ahead. Therefore, long-term investors should definitely add the stock amid market volatility.